welcome to another Market Minute. My name is Eric Odom. I'm the principal real estate broker for ROI Commercial Property Brokerage in Tampa, Florida. And today we're going to talk a little bit about a tax that has been placed on, or that's been, a lot of rumors have been going around about a tax, a 3.8% tax on real estate through the healthcare law that was just passed recently under the Obama administration. So we're going to try to clear that up a little bit today. We have with us Cynthia Petitjean. Cindy is a CPA in the state of Florida and a member of the Florida Bar since 1992. Her areas of practice are estate and tax planning, tax compliance, tax controversy representation, both at the federal and state levels, and probate administration. So, Cindy, thanks so much for joining us today. We appreciate it.
Thank you for having me.
Okay, so this is a pretty controversial tax. So in the real estate world, there's a lot of rumor and innuendo that's been going on about how this tax is going to be applied. But why don't we start first and talk about where did it come from?
On March 23rd, 2010, Congress and President Obama passed what's called the Patient Protection and Affordable Care Act. A portion of that act implemented a code section which assessed a 3.8% tax on certain high-income taxpayers effective January 1st, 2013.
Okay, so takes place 2013. So we're on top of it right now. So how can someone be affected by this? Let's talk about that. You say there's high-income earners. What exactly are those high-income earners?
Well, beginning on January 1st, 2013, this code section comes into effect. A high-income taxpayer is defined under this new law as a couple filing a joint return that is earning over $250,000. I believe that's adjusted gross income, which is the line on the bottom of the first page. For married filing separately, couples, that threshold is $125,000. And for all others, which would mean head of household or single taxpayers, income above $200,000. And this tax is not only assessed on what you are most interested in, which is the real estate income, but it's also on wages and self-employment income.
Gotcha. Well, it seems like it's in. Is there a number that's attached to the amount on the sale of the asset, the sale of the property?
Well,
there's a particular capital gains.
There is a formula which is probably too complex to get into over the telephone, but any of your listeners to this conversation can certainly contact me to discuss their individual circumstances. But for the most part, the 3.8% tax is going to be assessed on what is termed net investment income. And
gotcha.
investment income is traditionally dividends, rents, interest, capital gains, which you just asked about, royalties, and passive activity income.
Gotcha. So let's go ahead and just and have one. If somebody needs to talk about the specifics of this with you, why don't you go ahead and give them a telephone number? Because I know this is complex and it's going to be varying depending on each individual person's situation. So why don't you go ahead and give them a telephone number they can talk to you about whether they fall into this or not.
Yes, I can be reached at area code 813-659-2020, or if you prefer to email your question to me, I can be reached at cmp@cmp-law.com.
Great, thank you. Now, in terms of the amount, there was an email that went out and it said, hey, everybody's going to get taxed on the sale of the property. That's not really true. It doesn't really seem to be affecting a large number of people. Is it?
That is a misconception, I believe, of once you sell property, you're going to be taxed on the gain of the property. First off, There is the potential gain that an individual or a joint filing couple might recognize upon the sale of their principal residence. Briefly, you can exempt up to $500,000 of gain if you're filing a married filing jointly return, or up to $250,000 of gain if you're a single taxpayer on the sale of your principal residence. Now, allow me to make a point here that that's gain. That is not total proceeds. So, for example, let's say you sell your house for $350,000. You may not have a taxable gain there if your basis, which is what you bought it for and what improvements you've placed into it, is greater than $100,000, let's say that you're a single person. So $100,000 basis minus $350,000 gross proceeds from the sale of it, what you received from the buyer, equates to a $250,000 gain. Under current law, that gain is excluded from income for a single taxpayer. That gain will also be excluded from the 3.8% tax. So for the most part, if you're under the thresholds of excluding the gain from a principal residence, you will be excluded from this tax. Also, the gain on the sale of non-principal residence property, i.e. property used in a trade or business, if that's sold and there's a gain and it's used in your trade or business, that will also be exempt because that's treated as trade or business income, which is not subject to the tax.
And I was going to say, let's talk about that because, I mean, obviously what I focus in on commercial, and there's been a lot of discussion about residential because that obviously is where most of the property in terms of value is, and there's a lot more residential agents out there touching people on a daily basis than there are commercial. And so I've not seen a lot of information specifically in regards to commercial, so I'm glad you touched on that. So why don't we talk a little bit about the rules for commercial, and is that the 250 exclusion principal residence? It doesn't really have to do with commercial. So why don't we talk about the commercial, the business side?
Okay. Property that is used in a trade or business, if that's sold and a gain is recognized, because it is in the bucket of a trade or business income, that is not considered under this law as net investment income. So that property is not going to be taxable if sold by a person in a trade or business. And let me make a point here that this tax is on the individual. So if you're a C corporation and you sell property that you've been holding for investment within a C corporation, this 3.8% tax does not apply to that C corporation. This is in what I call flow-through entities, partnerships and S corporations. It doesn't matter what the entity is, either a corporation or an LLC. It's the tax classification of partnership or S corporation. And the implications that occur in those entities flow through to the individual. So the character of the income that is recognized by the pass-through entity flows through to the individual, and that is where you apply the rules of what is net investment income versus active trade or business income. So, for example, let's say an S corporation sells a piece of equipment and they recognize a gain on it. That piece of equipment, if used in the active trade or business, is going to reflect a gain that's going to flow through to the shareholder. That is going to be active trade or business income and is not going to be subject to the 3.8% tax. On the other hand, let's say that S corporation was holding a share of publicly traded stock for investment purposes, and that was sold for a gain. That gain will be treated as capital gain that flows through to that individual shareholder, and applying the other thresholds of a high-income taxpayer and some other somewhat complex formulas may be taxed at that 3.8% rate.
And so let's talk about the reality of the situation. I mean, we've taken such a beating in real estate. It really, the values of real estate have been turned back a decade. So folks are probably, I'm saying probably because it's not exclusively the case, but probably they're going to have held this real piece of real estate for quite a long period of time to actually have experienced the capital gains, to have to pay for this tax. Plus, they're going to have to be in that 250 or higher income to be subject. Is that correct?
That's correct. Let me also point out that this is not only on capital gains. This is on dividends and interest. And I think even as importantly as a capital gain that might be impacted by this 3.8% tax is rent. And let me just address that briefly. Is rental real estate is, according to the Internal Revenue Code, treated as per se passive. Unless you're a real estate professional and can treat those rentals as an active trade or business, it's per se passive. The new law requires passive income to be subject to this net investment tax. Now, there is some confusion about whether this tax is going to apply to rents that a person materially participates. Now, I'm kind of getting into some pretty complex passive activity, material participation rules.
Yeah, it seems like an individual type of thing, Cindy. Let's let them chat with you on the phone about
yes, but I'm just trying to point that out, that there is some area of non-clarity in the law that we're expecting regulations to come out, but it could potentially be a point of planning. Gotcha.
Okay, good point. Let's talk about a doctor. We talked about having real estate for a long period of time and also having high income. So it seems like professionals are the ones that are going to most likely be affected by this. So, and in fact, I've had this exact case in the last month. A doctor who's had his building and his practice for 30 years or more, thinking about when to get out and how to get out. He's at that retirement age and making $280,000 a year, and he's got substantial gains on that building. I mean, he paid $100,000 for it back in whatever year that was, 1984, and now it's worth 5 times that. So it sounds like this type of an individual is going to be subject to that tax all around, doesn't it?
Potentially. It depends on how the real estate is owned, whether it's owned within the entity that he's selling and, it's actively used in the trade or business, which I'm assuming this will be his office. And so that gain on the real estate portion of it may be subject to the 3.8% tax. But remember, this is only above certain taxpayers that have a threshold. So hypothetically, if the doctor retires, his income is going to drop. So there's planning opportunities to perhaps look into an installment sale of that equipment or property used in the business to keep the gain low where he doesn't hit the thresholds. If he did sell the stock of the company, that may be subject to the 3.8% tax, depending upon the format of the entity that he's selling the stock in. So, yes, it could impact the doctor, but there are certainly planning opportunities to be looked at to make the tax implications as minimal as possible to this doctor on his exit strategy.
That's something I hadn't really thought about, Cindy. That's a good idea. I mean, the whole idea of the installment sale I hadn't really thought about, but what you're essentially saying is to pull that income stream on the sale over a number of years where you're actually going to be allocating a portion or significant amount of what he gets paid on his practice into the years that he's probably going to be earning less than the 250, thus pushing him out of being subject to the tax. Is that accurate?
Potentially, yes.
Okay.
Once again, it all depends on what the character of the income on the sale is, but hypothetically it would be ordinary income upon the sale of the assets. And you do endure the credit risk of collecting your sales price over a period of years, hoping that you have a solvent buyer. So you tend to have to balance the credit risk with the tax implications.
Gotcha. Well, I think that about sums it up. I mean, for the first time, I hear it addressed from the commercial aspect, and I really Appreciate your time and input on this, Cindy. One more time, why don't you give folks your telephone number in case they want to chat with you further about how they might plan for this?
Certainly. Thank you, Eric. It's 813-659-2020. I'd be delighted to speak to anybody who has heard this conference call and needs to have some specific concerns addressed. Or you can email me at my email address, cmp@cmp-law.com.
Great. Cindy, thank you very much for joining us. Once again, I am Eric Odom, Principal Real Estate Broker for ROI Commercial Property Brokerage in Tampa, Florida, and thank you for listening.